Welcome to the deep dive. Today, we're tackling a question that's probably crossed everyone's mind with all the economic headlines flying around. Is the Fed ruining your life?
Mm.
We're diving into the often confusing world of interest rates, economic indicators, and what it all means for your wallet. Our guide through these murky waters is an article summarizing economist George Gammon's work, which focuses on how the Fed's actions might actually be making things tougher for everyday people. So strap in. We're about to unpack Gammon's argument and see if the Fed really is the economic bogeyman some people make it out to be. Now, I'll admit, whatever here Federal Reserve, my brain kind of glazes over. It all seems so big and complicated. Can you give us a quick refresher on what the Fed actually does?
Absolutely. The Federal Reserve, or the Fed for short, essentially steers the ship of the U.S. economy, one of its primary tools,
Yeah.
setting interest rates. Think of it like adjusting the thermostat for the entire financial system.
Okay, so the Fed is controlling the financial temperature. Got it. Gammon's article zeroes in on this recent interest rate cut, 50 basis points, I believe. He suggests it might not be enough to stop a recession. What makes him so skeptical?
It's about context. You see, there's this thing called the two-year Treasury yield. Economists often use it as a kind of market-based prediction for where interest rates should be to keep things balanced. The Fed usually tries to align its rates with this yield, but right now there's a gap. And according to Gammon, that gap is significant. It's like the Fed is using yesterday's weather report to predict today's economic climate.
So the market is saying one thing, the Fed's doing another. That doesn't sound great. And this brings us to another term from the article that honestly sends shivers down my spine. The inverted yield curve. Is this as ominous as it sounds?
It definitely gets economists' attention. The yield curve is basically a visual representation of how much investors earn by lending money to the government over different periods. Typically, you'd expect a higher return for lending money longer term, right? That's where the curve usually slopes upwards. But when it flips, meaning short-term rates are higher than long-term rates, that's an inversion.
And this inversion, it's not just an abstract chart pattern, is it? There are real-world implications.
Exactly. Think of it like a financial earthquake detector. Historically, an inverted yield curve has been a surprisingly accurate predictor of recessions.
You know that feeling when the economy seems shaky? Well, the inverting yield curve is like the official tremor sensor going off. And historically, it's been scarily accurate. So we've got this potential recession signal flashing red. Gammon then lays out this wet, wad, and wild scenario where the Fed tries to douse the flames by cutting rates. But it might actually make the downturn worse. What's that all about? It feels like trying to put out a fire with gasoline.
It's a provocative idea. Gammon argues that sometimes cutting rates when the economy is already on shaky ground, well, it can create distortions that actually accelerate the downturn. It's like adding more water to a pool that's already overflowing. It doesn't address the underlying structural issues.
That makes sense. So we can't just rely on the Fed to swoop in and save the day with rate cuts. It's like trying to fix a broken light with a Band-Aid. What does Gammon think is at the root of the problem?
He's particularly worried about the growing wealth gap. You see, our economy has become increasingly reliant on asset prices, things like stocks and real estate.
And those prices have been going through the roof lately.
Exactly. But here's the thing. Those gains primarily benefit the wealthy, the folks who own most of those assets. Meanwhile, wages for the average person haven't kept pace. This creates a situation where the economy might look good on paper because asset prices are high. But it's built on a foundation of sand.
So it's like we're all standing on this economic fault line, and the people at the top might not even feel the tremors until it's too late. That's a pretty unsettling thought. And it makes me wonder, what can we do about it? What does Gammon suggest?
He points to excessive government spending as a major culprit.
Okay, that's something I hear a lot about. But I'll be honest, I always thought the national debt was more of a political talking point than a real-life threat. Should we really be losing sleep over it?
It's more nuanced than just saying debt is bad. Gammon's point is that unchecked government spending can distort the economy. And you guessed, it exacerbates the wealth gap we've been discussing.
So it's not just about the raw number of how much money the government owes, but how that debt can throw the entire system out of whack, and how it can actually make life harder for everyday people. This is really making me rethink my whole understanding of economics. It's like we've been looking at the wrong metrics all along. So it's not just about how much money the government owes, but how that debt can throw the entire system out of whack, and how it can actually make life harder for everyday people.
Yeah.
This is really making me rethink my whole understanding of economics. It's like we've been looking at the wrong metrics all along.
It is, it's a bit like building a house on a shaky foundation.
Yeah.
It might look impressive for a while, but eventually those cracks are going to show.
And I'm guessing excessive government spending is a big part of what's making that foundation so unstable. But how does that actually play out in the real world? How does all that spending make the wealth gap worse?
Imagine a garden hose that's only connected at one end. All that water is just going to gush out, creating a muddy mess but not actually nourishing any of the plants. That's kind of what can happen with excessive government spending. It distorts the natural flow of resources in the economy.
Okay, so instead of that money going towards things that create genuine, sustainable growth, it's more like creating the illusion of prosperity while inflating asset bubbles and widening the gap between the haves and the have-nots.
Precisely. And it's the average person who often ends up footing the bill for these economic distortions, whether it's through inflation, stagnant wages, or a lack of opportunity.
This has been eye-opening, to say the least. So for our listener who might be feeling like they just got a crash course in Econ 101, what are the key takeaways from Gammon's work?
First, don't just assume the Fed has everything under control. Those alarm bells about a potential recession, they're worth paying attention to. Second, make sure you're looking beyond the superficial economic indicators. Just because the stock market is up doesn't mean the average person is thriving. And finally, remember that excessive government spending can have far-reaching consequences. It's not just about some abstract number. It affects all of our lives.
It's a lot to digest, that's for sure. It sounds like we need to be having some serious conversations about how to build a more stable and equitable economy, one that works for everyone, not just those at the top. That's all the time we have for today's deep dive. If you're feeling inspired to learn more, I highly recommend checking out George Gammon's work. He's got a knack for explaining these complex economic concepts in a way that's both insightful and engaging. And hey, if you found this deep dive helpful, don't forget to subscribe and share it with a friend. Because in today's economic landscape, we could all use a little more clarity and a lot more conversation. Until next time, keep asking the tough questions. And remember, your financial well-being is worth fighting for.